Hey everybody, Marty Missouri. Good afternoon, May 22nd, 2017. This is what will likely be your weekly video as I'm going to be away from the office all week. I will have a connection, so I'll be in tune with what's going on in the world. If the market gets kind of squirrely, like it did this last week, I'm sure I'll find my way to the blog and offer up my thoughts. As you should have gathered from the written part of the post, we here at Private Wealth Advisors are painstaking in our efforts to make sure as best we can that each position in every client's portfolio makes good sense, that it has a good setup, that the probabilities are such that suggest that the odds are better, that there will be good things going forward within the time horizons of each client. Of course, time horizon is an issue. We can have setups that begin to deteriorate but feel good about the long-term prospects, hold on to those positions, add to those positions, etc. Of course, when things really begin to break down based on the data that we review and update and analyze, then we're going to make some decisions in terms of the allocation. So what I wanted to do here today was kind of allow you all to be flies on the wall, if you will, to the meeting that we're not going to have this week with staff. You can call it a strategy session. We're not going to go into all the things that we go into. We're not going to talk about the economy today or fundamentals. I'm just going to show you the technical analysis that we would do in the meetings. But I think you'll find it instructive, and it'll give you more insight into why we do what we do here. So this is really more for clients than other subscribers to the blog. Just to give you a heads up in terms of what you're going to see in the next few minutes. So what you see in front of you are the 50 on top, 100 in the middle, and 200-day moving averages for the S&P 500. And this is a one-year daily chart, and as you no doubt know if you've been watching these videos, this would be considered a bullish setup. So here we have good form, we have good positioning, we want to stay in the game with stocks based on what we see here. Now, taking a look at retracement levels, we've talked about this before here on the blog, Fibonacci retracements, very, very important indicator for technical analysts and folks who trade the technicals. What we look for are retracements that we find within the context of an upward rising market. So here we have the election low, and I'm going to go back to this on each one of the charts you're about to see. So this was early November. Here's where the market bottomed after the concerns over the election. Here we are going up to all-time highs. So with the retracement, we start here, and then we put the top at the high in this particular rally. We did open higher here on May 16th, but actually closed lower. So on a closing basis, this would still be the high. We're looking at these 38.2, 50, and 61.8 retracement levels. These are very, very common. It's almost unheard of that a longer-term rally does not come back and retrace, often the 50% level. There are strategies that basically have traders rush in when we've had a 50% retracement of a recent rally. So currently, while we've traded off a little bit, we know we've had some political issues this last week that played havoc with the market, had a gap here on Wednesday that's just yet to be filled. It likely will get filled because most of these sorts of gaps do. But there's a lot further to go before we'd even begin thinking that this rally and this bull market is about to give up the ghost. So now let's look at other parts of the world. The EFA, Europe, Australasia, and Far East Index, is very prominent in our portfolios. We use EFA or IEFA, which are exchange-traded funds that capture the movement of that index. This is the 50, 100, and 200-day. Folks, it does not get any more bullish than this in terms of probabilities going forward. So we really haven't had any kind of a breakdown. In fact, we just have a very recent all-time high. So we could see lots of retracement within the context of an ongoing bull market. The Eurozone, something I've been bullish on, as you know, for quite some time as well. Exceedingly good setup. Huge outperformance this year for the Eurozone versus the U.S. Lots of room to come back, take some profits, consolidate here before we begin to get nervous about that from a technical perspective. DEM, the Wisdom Tree High Dividend Emerging Markets ETF. There's two primary ETFs that we use. There's this one. You can see a pretty good look, very much lined up in bullish territory. We did have some fallback this last week. There was a political scandal in Brazil where the president was caught on tape, and that really did a number on emerging markets in general. This fund actually only has a little more than 3% in Brazil, but one thing's for sure, when something goes awry in one emerging market, traders do tend to punish all of them. They expect a lot of selling pretty much throughout the whole space. Nice bounce back on Friday. But again, even then, we've had such a nice run that these retracement levels are just yet to even be touched. the Vanguard Emerging Market Index ETF. Not after high dividends. This is more growth, follows a different index. Exceedingly good setup, just like the other non-US indexes. Also took a hit, has about 8.5% in Brazil, but took no bigger a percentage hit than DEM. Bounced back again nicely on Friday. Not touching any retracement levels that would even have us thinking yet that it's even a normal retracement. Financials, our largest individual weighting. We started the year at 20%. We have reduced it to 18%. And the 50-day moving average is telling us that things are kind of been negative here on a short-term basis. It's now dropped below the 100-day moving average. The longer-term trend is very fully in place, telling us that this is still very much an uptrend. Here's a look at the Fibonacci retracements. Notice that since the all-time high, after that huge run, this is still, since the election, the best performing sector, but it has not done much this year. Look how many times the sector has tested that 38.2% retracement. You can see what's happening here. Traders coming in. When it took a hit on Wednesday, right down to that 38%. Traders coming in again. This is offering very firm support right here at around $23 a share for that particular ETF. So we are very much within the context of a bull market. This is still a very normal retracement. We can go right into here, and it would still be considered a normal retracement within the context of an ongoing bull market. Technology, best performing sector so far this year. Exceedingly bullish setup there. Nothing of threatening in terms of retracements, not even close at this point. Industrials, 15% target to industrials. Pretty good setup. A little bit of flattening in the shorter term indicators. See a little bit of weakness here, kind of maybe a consolidation, not touching any key retracement levels just yet. Transportation, which is found inside the industrial sector, very important sector to keep an eye on for obvious reasons, as trucks and planes move goods throughout the world. Rolling over in the short and intermediate term, moving averages very firm in the 200-day. Retracement back to that 50% level once, almost twice, again the other day, and then bouncing off of that. Important one that we keep our eye on, not only just in terms of the market and industrials, but also in terms of what it means relative to the rest of the economy. Basic materials, we've got still a pretty bullish setup. Again, kind of a flattening as the market looks to have consolidated. Have yet to touch that 38% retracement. Came close on Wednesday. Still solidly in an uptrend for materials based on how we look at things. Consumer discretionary, second best sector behind technology so far this year. Great looking setup there. Lots of room to retrace or correct going forward. Home builders, part of the consumer discretionary index. The home builder index, as you can see, very firm. And you can see we've got quite a ways to go before we're even thinking about this particular bull market in housing, or at least home builder stocks ending. Healthcare, we upped our target to healthcare from 8% at the beginning of the year to 10%. Began looking very good, technically speaking. Flattening of the 200-day. This looks good. It's flattening out a little bit here in terms of retracement still. Very much remaining in a bull market for healthcare. Consumer staples, we're maintaining our 8% target this year. Very flat 200-day. That would question the longer-term trend. These things keep up, and you will see that begin to slope higher. In terms of retracement, still nothing even close to begin thinking about there with staples. Energy has broken down dramatically. We came into the year with a 10% target to energy. We've had to reduce it now down to 6%. From an economic perspective, if you look at where we appear to be in terms of the stage in the cycle, normally energy would be the best or one of the best performers, but we have real supply challenges. So it's a tough picture right now. News over the weekend would suggest that energy could have a pretty good week next week. There seems to be firm commitments with outside of North American producers to continue to limit production going forward and try to boost the price. But again, it's been a real number on the sector, and here's those Fibonacci retracements. You can see we came out of the election. We had a really nice rally. This is 100% retracement. This would be strong support. I'm sure a lot of technicians are buying this level. But as it stands right now, we're looking at really a bear market in energy. And the 200-day rolls over, and we've got the ugliest possible picture for energy stocks. Still maintaining a 6%, however, because of where we sit in the economic cycle And we do know that there is tremendous incentives for producers, at least outside the U.S., to try to get the barrel of oil higher, should equate to higher earnings and so forth. So I'll say it one more time. While we're looking at a sector that would normally have a substantial weighting in our portfolios, the technicals have broken down quite dramatically, and we're very aware of what the fundamental picture is in energy. I do think it can get better going forward. We're going to keep our mid-single-digit exposure, I suspect, but willing to make adjustments as things either improve or break down going forward. Utility has been interesting. We came into the year with a zero target to utilities. We're actually at 2% now because the technicals have really been telling us to allow for some exposure. Exceedingly interest rate sensitive. Economic data and where I think we are in the cycle does not bode well for utilities. You can see they're just really, the bulls and bears are battling it out right within a trading range. There's the recent high. Nothing that looks like a retracement, but we're just not comfortable with the interest rate sensitivity to go big into utilities at this point. We will again at some point, but we don't think so in the very near future, although we'll keep our minds open to all possibilities. Telecom, we don't want any of it right now. Here is the moving average look. That is a very bearish look, particularly if the 100-day drops below the 200-day, but right now everything's sloping in the wrong direction. Here's a look at the move out of the election, from the election low, quickly got to this high and has quickly broken down below the 62% retracement. That's a very ugly technical look that would suggest probabilities in the telecom space would be lower at this juncture. Nothing's guaranteed. Again, we'll keep an open mind, but that's not an area that we want to be in. This does not look like a good investment to us. Winding it down with real estate, we are maintaining a zero target to real estate investment trust. Very ugly look. This is a relatively new fund. Clients may recall when Standard & Poor's separated REITs from the financial index and our XLF exposure got split to XLRE. We quickly sold the new XLRE and put it right back into XLF. That turned out to be a pretty good move. This breakdown shows you how bad the price action has been. A little bit of a move out of the election. You can see we came up to here, testing that 38% retracement. But from a valuation standpoint, as well as a timing, interest rate sensitivity standpoint, this is nothing that we want to engage in, at least at this juncture. So folks, to kind of sum it all up, and in the spirit of the blog post that you just read, our aim is forever to make sure that we have our client portfolios allocated in the areas that have the best setups, that are showing good form, seem to be in rhythm, where we think the probabilities are that the shot is going to go in, if I may use the basketball analogy. And I just gave you some insight into the things we talk about, looking at it sector by sector. There's more ETFs that we use, other things that we talk about as well, but we just looked at the primary sectors as well as the S&P 500 and other markets as well. Thank you as always for watching and listening, and I'll be back very soon. Take care, folks. Bye-bye.